welcome back to the Holistic Hustle, and in this video I'm going to be giving you what I believe is the most tax efficient and easiest way to pay yourself as a director of a limited company in this financial year, which runs from 6th of April 2024 all the way to 5th of April 2025. But make sure you watch until the end, as I'll be highlighting certain scenarios where you may actually want to pay more tax. Before we start, I have to highlight that this is not financial advice, nor am I an accountant. However, the whole purpose of this channel is to share business related knowledge and to simplify information which I think is unnecessarily complicated, to give you the tools and knowledge needed to excel financially. To make this video as effective as possible, I'm first going to run through the tax and allowances you and your limited company are subject to, which are essentially all the variables involved in calculating your taxes. So these include income tax, national insurance, corporation tax, dividends, and the employment allowance, which we'll look at the end. Once we have an understanding of these topics, the whole video should come together nicely. And most importantly, this information will give you a much better understanding of company taxes, which will inevitably help you make more educated decisions going forward. So enjoy the video. Firstly, let's take a quick look at income tax. Income tax is paid on your salary through the PAYE payroll scheme. It doesn't include dividends payments, and dividends are taxed separately, and we'll go through that in a minute. For now, let's look at income tax rates for the tax year 24-25. You have a tax-free personal allowance of £12,570. Once you surpass that threshold, the following income tax rates apply. A basic rate of 20% on earnings between £12,571 and £50,270. A higher rate of 40% on earnings between £50,270 and £125,139, and an additional rate of 45% on any earnings exceeding £125,140. So I have a couple of points which might be worth noting before we move on to national insurance. For every £2 you earn over 100,000, you will lose £1 of your personal allowance. So you end up paying a 20% basic rate much earlier. For example, if you earn £120,000, you will lose £10,000 of your personal allowance, meaning you'll start paying 20% income tax from £2,571 as opposed to £12,571. Finally, it's worth noting that these tax thresholds have been frozen until 2028. And although this might sound great at first, it might simplify calculations in the future, this is actually a method governments use to collect more taxes without increasing rates. It's called fiscal dragging because more people are dragged into higher tax brackets as wages increase over the same period. There are a total of 6 national insurance classes, but for now you only need to be aware of 3 of these classes, particularly if you're going to be following the advice in this video and pay yourself in the most tax efficient way possible. The first is the lower earnings limit, and I like to call this the pension threshold. Please note, this is not the point at which you start paying national insurance, but it is the point at which you qualify for various benefits, most noticeably the state pension. So providing you earn over this amount, which is £6,396 per year, you will qualify for 1 year's worth of lower earnings limit contributions. The second type of national insurance I want you to be aware of is the primary threshold, which I like to call the employee threshold. And this is when employees start paying NI. So if you're paying yourself via the PAYE scheme through your own limited company, then you will effectively start paying 10% of national insurance on anything you earn between £12,570. So it's the primary threshold, also known as employees NI, and it's £12,570, which some of you may have noticed is the exact same as your personal allowance. In effect, you'll start paying 8% national insurance on anything you earn between £12,570 and £50,270. And then anything you earn above £50,270, the rate actually comes down to 2%. So in summary, you'll be paying 8% for earnings between 12,571 and 50,270, and you'll be paying 2% on the proportion of your earnings over 50,270. And finally, we have the secondary threshold, which I like to call the employer's threshold, because this is the national insurance paid by your company for employing resources. And remember, this does not apply to hiring freelancers. This is only applied to employees which are resources paid through the PAYE scheme. As I said, this is when employers start paying national insurance. So if you employ yourself as an employee of your own company or anyone else you employ, and you or they start to earn over the threshold of £9,100 per year, then your business will start paying employees national insurance. And that is paid at 13.8% above the secondary threshold. So anything above £9,100, then your business will pay national insurance. And there's no reduction for this once you get past £50,270 as you do in the primary threshold. And just a final point on national insurance. Combined employees and employers' national insurance can be as high as 23.8% when you add them both up. So that is why we pay ourselves the way I'm going to recommend, to avoid having to pay 23.8% national insurance. A couple of things to note before moving on to corporation tax. As a heads up, if you first started making national insurance contributions after the 6th of April 2016, regardless of whether it was in this business or your last employment, then you will need 10 years worth of LEL, lower earnings limit contributions, before you can qualify for any state pension. To get the full state pension, you will need a total of 35 years or more of contributions. And anything in between that time will be calculated on a pro rata basis. For example, if you've contributed 15 years worth of national insurance, then you would divide the full amount of the state pension, which is £203.85 a week, by 35 and multiply it by the number of years you've contributed, which in this example is 15. So you'll be entitled to a state pension of £116.49 per week. The next point to consider is if you have a gap in your national insurance record which you want to cover, then you can voluntarily contribute to your national insurance payments by paying something called Class 3 insurance, also known as voluntary NI. This might sound strange at first, but it could be useful for you if you are unemployed for a long period of time for whatever reason, and this works out to be £17.45 per week. In summary, if you're not working, then you can voluntarily pay £17.45 per week to ensure you still work towards your contributions and get a state pension. For those that are wondering how you or your employees make these national insurance payments, then it's worth knowing that you would generally do this through your monthly payroll via the PAYE scheme, which your accountant sets up and manages. So all you would need to do is log into your banking and make the payments once a month or once a quarter. If you need any help doing this, then I've found Xero to be the most helpful tool when it comes to finding accountants and setting up PAYE. And I've left a link in the video's description. The next thing I want to cover briefly is corporation tax, which is paid on the net profit made by a limited company. It's not paid on your revenue or turnover, it's only paid on profits. It's also worth noting that there are allowable business expenses that can be used to offset against your profits, such as your salary and product purchases or services, and this will reduce your corporation tax liability. So keep these all in mind, and I promise it's all going to come together later on in the video. The corporation tax rates for 24-25 are as follows. 19% for profits less than £50,000, which is also known as the small profits rate. Between £50,000 and £250,000 worth of profits, there's going to be something called marginal relief, which is slightly more complicated, but there's a simple calculator which you can use on the gov.uk website, which I've left a link to in the video's description. And any company making over £250,000 worth of profits, then the tax rate, the corporation tax rate applied to those profits will be 25%. A couple of things to note before moving on to dividends. If you fall within the marginal relief brackets, then you will have an effective corporation tax rate of somewhere between 19% and 25%. The closer you are to £50,000 profits, then the closer your effective corporation tax rate will be to 19% and vice versa. The closer your profits are to £250,000, then the closer your corporation tax rate will be to 25% as opposed to 19%. But it will never be less than 19% or above 25%. Before I get to the actual salary, we'll look at dividends. Dividends are only payable to shareholders from profits or retained profits from previous years. So always make sure your company is in a good position to pay dividends when you do this, as the last thing you want to do is pay yourself dividends that the company can't actually afford, as your accountant will likely instruct you to either pay it back or put them back in as a director's loan, which is a situation you want to avoid as it will cause cash flow issues. As long as you have enough profit in the company, you can literally pay yourself dividends however and whenever you like, at random points throughout the year or monthly or however else you like. And it's also worth knowing that dividends tax is paid after you do your self-assessment. So it's not an upfront tax which gets deducted every time you pay yourself dividends. You pay it once you've done your self-assessment, and then the tax on your dividends is due at the end of the 1st January after your self-assessment. So it's always a good idea to have a rough idea of how much you owe to make sure you have enough to pay it. There's a tax-free dividend allowance of £500 this year, which has come down from £1,000 last year, meaning you can pay yourself £500 dividends without paying any tax on it whatsoever. If you have any unused personal allowance, you can actually take them as tax-free dividends instead. So if you don't have PAYE set up already, then you can transfer yourself up to £13,070 as dividends, which is your personal allowance of £12,570 plus the tax-free dividends of £500. Now, I'm sure you're wondering what the dividends tax rates are for the tax year of 24-25, so here we are. Firstly, when it comes to dividends, you have a tax-free allowance of £12,570 plus your dividends allowance, giving you a total tax-free allowance of £13,070, as we've already discussed. Once you surpass a £13,070 threshold, the following dividends tax rates apply. Firstly, you get a basic rate of 8.75% on earnings between £13,071 and £50,270. A higher rate of 33.75% on earnings between £50,270 and £125,139. And you have an additional rate of 39.35% on any earnings exceeding £125,140. So those are the dividends tax rates for 24-25, and you may notice that the thresholds are the same as your income tax. Although the tax rates are different, the threshold brackets are the same. I want you to know that this is the most tax efficient way to pay yourself with regards to personal tax, and this will apply to the majority of directors who do not have other sources of incomes and who do not have another unique situation. Now, just before I show you my recommended salary, if you're finding this video helpful, I'd appreciate it if you could scroll down and hit that like button. And of course, if you want to see more content from me, make sure you hit that subscribe button too. Even if you don't think you want to see more content, hit the subscribe button anyway, because you've got nothing to lose and a lot to gain. So here we are, my recommended salary. For the tax year of 24-25, I recommend taking a salary via the PAYE scheme of £12,570 per year, which is £1,047.50 per month. And any payments you take above this, I would pay myself using dividends and pay dividends tax on those separately. There's a couple of reasons why I would recommend that this year. Firstly, it uses up the full personal allowance, meaning there's no income tax due on this money. Secondly, it's above the lower earnings limit national insurance threshold, which I called the pension threshold. So I'll now qualify for the full state pension. It's also below the national insurance primary threshold, which is when employees start paying national insurance. So there's no employee national insurance due on that money. but it's above the secondary threshold. So employers' national insurance becomes due from £9,100 and all the way up to the salary you'll be taking, which is £12,570. Since the rate of employees' national insurance is 13.8%, you'll be paying that on the proportion of your salary above the limit. So £12,570 minus £9,100, which is £3,470. 13.8% of £3,470 is £478.86. And although that doesn't sound great, that money's actually tax deductible from corporation tax at a minimum of 19%. If we compare the amount we've paid in national insurance, which is £478.86, with the amount we've saved by reducing our corporation tax, so 19% of £3,470, which is £659.30, then you'll see we've actually made a total saving of £180.44. With regards to your total annual income, any money you would want to take above £12,570 should be taken in dividends. Because the rate of dividends tax is lower than the rate of income tax at any threshold, anything over £12,570 is more cost effective to be taken as dividends. So there you go, that's my recommended salary for the tax year of 24-25. Now we're going to look at a few scenarios where you may actually want to pay yourself more PAYE and less dividends. But before we do that, I've got a few things to note. There's an employment allowance of £5,000 per year, which can be used to reduce your employer's national insurance. In order to be eligible for the employment allowance, you would need to meet certain criteria. So if you're the sole director of your company, then you would need to employ at least one other employee as well as yourself who is earning over the secondary threshold of £12,570. If your company has multiple directors, then your company would need to employ at least two directors whose relationship is irrelevant, meaning it can be a husband, wife, friend, family member, or anyone else, both of whom should be earning above the secondary threshold. To put this into perspective, if you claim the employment allowance and you have two employees on the salary discussed in this video of £12,570, then you'd be able to avoid paying employers' national insurance, as you would have a £5,000 per year allowance to cover that. And you would still fully benefit from the corporation tax savings discussed in the previous section of £180.44. So there you go. That's my recommended salary for 24-25. Thanks so much for listening, guys. If you found the video helpful, I'd appreciate if you scroll down and hit that like button. If you want to see more from me, subscribe to the channel. You've got nothing to lose and probably a little bit to gain. And if you want to know some of the business expenses that you can use as tax deductible, then I'll be doing a video on that soon, and that should be popping up anywhere now. Thanks for watching, guys. I hope you found the video helpful, and I'll see you in the next one.